I'll talk about the performance in the fourth quarter and our thoughts on that. And then secondly, talk about the positioning of the funds right now. And I think we've got some Q&A after that. So perhaps if anyone has some questions, we can talk about whatever you want. I'll answer whatever questions come in, of course. So the first thing that we wanted to talk about was the performance in the fourth quarter. And the fourth quarter, of course, was a very interesting time for markets. And just to set the scene, of course, there were two big things which happened in the fourth quarter. And we would say that they're two extraordinary things. The US election result, I would characterise Donald Trump's presidency as a relatively extraordinary presidency by historical standards. So the fact that you unwound that with Joe Biden winning, and then you've got the a lack of a democratic sweep of Congress in the White House. Of course, they have a weak sweep now with 50-50 in the Senate, but a lack of a strong sweep, which would have given them a mandate to do something very strong, that really de-risked markets, okay, particularly on the Trump side, because we all know that he was very, had a non-traditional governing style. So that was the first thing. And then the second thing, of course, was the very positive vaccine results which came out. And if we all think about 2020, of course, COVID-19 was a very extraordinary thing which happened and, of course, impacted our daily lives and economies. So when that came out, and it really gave us a pathway or an exit ramp out of that malaise, that was a very extraordinary event itself. And in these two events, the election result and the very encouraging vaccine results happened very close together in early November, if you recall. And what that triggered in the markets was a risk-on type markets. And so we would explain that by saying risk premiums came down in all asset classes, not only equities, but some of the higher risk asset classes. So we're thinking here like Bitcoin. We can argue about whether that's risky or not, but typically that is seen as a higher risk type of asset class. Emerging market equities, emerging market currencies, junk bond yields, all of these things really performed quite well because it was a risk-on market. And I think the key here is that when the Federal Reserve came out and said, by the way, the economic outlook looks a lot better because of those two things, and despite that, we're going to keep interest rates low, that really added fuel to the fire. So I think that really is the background to the extraordinary November equity market performance. I think the MSCI World Index, it had its largest monthly gain in November in 50 years. So, we don't expect that to continue. So onto our performance. And remember that our fund is a defensive quality biased fund. Our two objectives, of course, are achieving 9% post-fee returns through the cycle, or at least over the medium to longer term. And secondly, the second thing is to reduce the sensitivity of the portfolio or returns in drawdown. So if the market goes down 20%, we typically want to go down less than that. And we actually have a metric which we abide by stringently, which says that our correlation or capture of these downside markets, or markets in general, is capped at 0.8, okay? And that's a portfolio constraint that we have. So when markets go down, we're not going to go down as much. And when markets go up, we're not going to go up as much. And that's a portfolio construction thing. And the reason why we put that in, and this gets to why we didn't capture all of that upside, is when we're thinking about investing, people, no matter how you invest, you want to invest in something that you have conviction in. We have conviction in investing in high quality companies which are going to earn shareholders a lot of money, and therefore unit holders and our investors a lot of money. That's the way that we invest, and that's a medium to long-term style. But some other people might say, well, we have conviction in trading, US election outcomes and vaccine results and all that sort of stuff. That's fine. That's not our way of doing it, because we truly believe, and still truly believe, that the best way to make money over the long term is in these companies which make more money than average in the long term. So that's our bent. So are we worried about the underperformance in the fourth quarter? No. And there's a couple of reasons. The first reason is that the performance of the fund was not unexpected. I mentioned earlier that we would not capture all of the upside, and that was certainly the case. It would be worse for us, and I would certainly not be sleeping as well at night, if instead of not capturing the upside, we failed on the downside. So what I mean there is, if markets fell, we fell more than that. That would be against our labels, so to speak. So that would be the main reason why we're still comfortable with our fund and our strategies. The second thing is, when we think about the underlying thematics that we're playing in our portfolio, and I guess now I'm moving on to the second thing, which is portfolio positioning. Some of those things are still intact. Okay, so if you look through our invested companies, you'll notice that there are several thematics, and I can talk about some of those later, but I'll just quickly mention some of those. So the first one would be pay TV, or the shift from pay TV to streaming video on demand. So remember, you used to have pay TV and you'd sort of flick around with your remote. Now, it's a mobile experience with Netflix. Netflix is one of our larger positions to try and capture that long-term change. So again, we're not punting short-term earnings results or anything like that. I think this is a structural change, and that's something that is certainly not being damaged by what happened in the fourth quarter, or even what happened in 2020. The second one would be physical cash to electronic payments. So I'm not sure how many people use cash anymore. It's a little bit harder these days, but tap and go, that's something which is rolling out globally, and particularly in America. America typically lags on this sort of stuff. The shift to the cloud is also something. So if you think about all of these cloud providers, Alibaba, Amazon, Microsoft has one with its Azure platform. Some of the Chinese companies have it as well. So instead of downloading, I don't know if you remember when you used to get Windows and you used to put the disks in the computer. Now it's all on the cloud. So that is a shift which we see continuing for a while, and in fact, some of our companies are poised to benefit from that. And the last one I would say is digitization of markets. And here, what kind of markets are we talking about? Well, obviously, you've seen the advertising market. I'd say that has been digitized, and that's, again, a long-term thing. If you think about the proportion of advertising revenue, which is being captured by things like Facebook and Google. We've all seen the charts where the line sort of goes from bottom left to top right. There's still some more gas in the tank on that in our point of view. And another market would be the US mortgage market. And here I'm talking about the back-end processing. One of our new invested companies, Intercontinental Exchange, or ICE, which is listed in the US. They actually own the New York Stock Exchange. They're making some big moves there. And of course, financial markets are becoming even more electronified. I think we can all think of the pit traders and those sorts of things that don't really exist anymore. They're just for the TV, but now everything's done electronically. Just before we go to Q&A, I might just talk about some of our portfolio holdings and what we've changed in the fourth quarter. So we've increased our risk appetite. If you watch some of our videos, we talk about that. And I mentioned earlier we have this 0.8 cap. We call that our combined risk ratio. It's our capture of markets to the upside and the downside. So in the quarter we increased that. That's now sitting at 0.74. So it's not a 0.8. We're not maximum risk on here. But it was, just for context, it got down to 0.66 when we really sold off and reduced risk earlier in the first part of last year. So that's one thing that we did. We increased the risk in our portfolio because of those things which I talked about. As a associated point, we've reduced the cash in the portfolio. That's down 4 percentage points. That's now 8% at the end of last year. And again, for the same reasons.